markedly high and some markets not working at all, the government is very right to step in, I believe, and provide the risk-bearing services that nobody else seems willing to provide. That's the central idea, for example, behind the TALF, which is starting, I guess, any day now. I'm not exactly sure when it's starting. I'd like to contrast that, by the way, with another aspect of quantitative easing that's been much discussed, which is buying long-term treasury bills. One can imagine a time and a place where that's an appropriate thing to do once you've beaten the short-term interest rate down to zero, but I don't see that this is the time or the place. I don't see what would really be accomplished by doing that. The problem is not that we have a yield curve that is too upward sloping and that's doing damage. In fact, that's helping the banks recapitalize themselves, so we really don't want to flatten it. And there's no problem with riskless borrowing by the U.S. Treasury, which is still cheap. We need to work on the risk premia that private borrowers have to pay above treasuries when they borrow, and that's when the TALF and the other...
Let me say the relaxation of the 5-minute rule will apply to our witnesses. Again, with the luxury of a fairly small membership, we can have some intelligent discussion, unstructured by these time limits.
So did that mean I'm cut off, or I have another 2 minutes?
No, you get some more time.
Okay, thanks.
I'm sorry.
The last thing I'd like to touch on, which has been much discussed in recent weeks, is nationalizing banks. I don't think the talk of doing that has been particularly helpful. You can see that in the markets. That said, I recognize the possibility that at the end of the road, after plans A, B, C, and maybe D fail, if they do fail, we may be there. So we should be realistic about that. But I don't think we're there now. And as I say in the testimony, my problems with rushing to nationalization can be summarized in 4 words, and those 4 words are, we are not Sweden. And by saying that, I mean a couple of things. The most important is that Sweden just had a handful of banks to manage. We have over 8,500 banks. This is not a trivial management task. And importantly, it's not at all clear where you draw the line. We're going to nationalize 2 banks, 4 banks, 8 banks, 1,800 banks. There's a problem here because if you nationalize Bank A and Bank B has to go to market competing with Bank A, which has the power of the federal government behind it, you've put Bank B at a competitive disadvantage. You may drive Bank B into such a state of ill health that it has to be nationalized, and down the chain you go. As I say, we may have to get there at some point, but we're not there yet, and I hope we don't get there. A second problem is that once you start going down this list, you encounter what some people have called the slowest antelope in the herd problem. As speculators set their eyes on who's likely to be the next nationalized bank, and they attack it with short selling and selling the CDS, and so on. Thirdly, and here I would bow to the judgment of this committee, of course, but as a citizen, the Swedes did their nationalization and denationalization with remarkably little political influence. It was a very technocratic operation. As a citizen, I'm a little dubious that it would work that way in the United States of America. And let me leave it at that, Mr. Chairman.
Thank you. I will just interject myself now to say that I would hope people would keep in mind one very important fact. If you want something to be decided essentially non-politically, do not ask 535 politicians to decide it. I think that is endemic, not a bad thing either in our system, but something to be taken into account. And next we have another frequent witness before the committee in a variety of capacities. Professor Taylor, John Taylor is the Marion Robert Raymond Professor of Economics and the Bowen H. and Janice Arthur McCoy Senior Fellow at the Hoover Institution and a former, was it Deputy Secretary, John, Undersecretary of the Treasury for International Monetary Affairs, and so we are glad to have Dr. Taylor return.
Thank you, Mr. Chairman. Thank you, Ranking Member Baucus, for inviting me. I'm going to focus my opening remarks, in fact, much of my written testimony on the extraordinary measures part of the request to testify, and I appreciate being invited here to do so. I think the first place to begin to think about these extraordinary measures is to look at the extraordinary increase in reserves at the Federal Reserve. And in my written testimony, I provided a chart. This chart, I think, is very useful, somewhat sobering, if you like, and it's worth a lot more than 1,000 words. Reserves, of course, are the deposits that commercial banks hold at the Federal Reserve. It's a form of money. Economists call it central bank money or base money. It's really the foundation of the whole money supply in the United States economy. If you look at that chart, you can see in September of last year, it started really exploding, I think is the word, and within a few months increased by 100 times from roughly $8 billion to over $800 billion. Again, these are the deposits that banks have on reserve at the Fed, can be converted into to loans at an instant. This increase in reserves, I have both what has happened until now, it's a solid line in the picture, and also what might happen in the next few months based on current policy. Now, why has this increase in reserve taken place? Why has this huge expansion in the creation of money, if you like, taken place? Well, it's because the Fed has used these reserves, used the creation of this money to finance the purchases of securities in the private sector, whether it's mortgage-backed securities now, or whether it is these securities that resulted from the Bear Stearns intervention, or whether it's the AIG securities, or whether it's loans to AIG, or whether it's the new purchases that will take place under the TALF or under the recent proposal from the Treasury to create an initiative for consumer and banking loans. In other words, just like any other organization, the Federal Reserve has to finance its purchases or its lending, and it finances them by creating money. It can finance them in other ways, but that's the main way it's doing it right now. If you look at that chart, you can see these reserves didn't increase for the first 13 months of the crisis. It was basically flat, and that was the way the Fed was controlling the interest rate. It started to explode when the Fed had to create money to provide these purchases. Now, where is this going in the future? I have estimated, based on the proposal from the Treasury and the existing proposals from the TALF, that we'll have to increase a substantial amount more, and that's what that dotted line is trying to show you. It's really a continued explosion of this creation of money. So that's my assessment of where we are and where we're likely to go with respect to probably the best overall measure of the extraordinary measures that have taken place. Now, I have a few questions and concerns and a couple recommendations, which I'll mention in the time allotted to me now. One concern of this is, of course, is potentially inflationary. If the Federal Reserve doesn't bring those reserves back out of the system, at some point in time, it will cause inflation. That's a huge increase in the money supply, and it will translate into inflation at some point. People ask me about this all the time. It's on their minds. It's a concern. The Federal Reserve needs to address that concern. Right now, of course, we don't have an inflation problem. We seem to have the opposite. Inflation seems quite low. So it doesn't appear to be a problem now, and that's why the chairman has indicated he can withdraw these at the right time. I think the question for this committee and others is to ask, how will they be able to withdraw such a large amount of funds? That will mean selling these mortgage-backed securities, selling the consumer loans, et cetera, and it may be difficult politically. Second concern I have is I think it raises questions about the independence of the Federal Reserve. The recent proposal from the Treasury, the Consumer Business Loan Initiative, seems to me very similar to the kind of things that the Treasury did with the Fed before the so-called Accord of 1950, when the Fed was given independence to conduct monetary policy. It's a request for the Federal Reserve to do things which it might not otherwise want to do or have appropriate to do, that is to create this loan facility. Third concern I have is that not all of these measures are clearly productive. The statistical studies I've done, for example, shows that the term auction facility has not alleviated the risk premium at all, and I think one of the reasons for that is that it's not to do with liquidity, it's to do with pure risk issues. Also, like my colleague Alan Blinder, a lot of the interventions have really not been rules-based at all, but have been ad hoc and have caused more confusion, if you like, more uncertainty in the marketplace. I'm not sure that we've improved the rules-based aspect of this, but I certainly hope that he's right. And then finally, I think this raises issues about the future of the Federal Reserve. These actions, while viewed extraordinarily now, could in principle become part of the normal way of doing business at the Federal Reserve. And that would raise grave questions about, to me, about the success that we've had for 20 years, if you like, with monetary policy, focusing on the overall economy, setting interest rates according to inflation and output. But if it becomes an organization of selective credit provision, whether it's bad times or weak times or just not so good times, it will raise serious questions about the effectiveness of the institution. I have 3 recommendations. One, I think there could be more transparency about these operations. And in this regard, I think the recent creation of a website by the Fed just this week, I think it began on Monday, is very good news. This is the first time people can get in and see exactly, understand this complication of their releases, and I congratulate this committee for encouraging that in the hearing on February 10th. I think more could be done. I've been urging they publish the daily data. So, for example, we would know right now what the provision of reserves is for every day of last week and don't have to wait until the week is over on Wednesday. Very important. I've been urging it for years. I think the Fed should also set ranges for these reserves that I've showed you in my picture. Right now, all they say in the minutes of last meeting was that the balance sheet will be kept high. That seems to me is too vague. What does that mean? Does it mean it's going to be at the top of my dotted line? Or is it going to mean the top of the blue line? What does it mean that reserves are going to be kept high? More specificity is needed. And finally, I would recommend that each of these measures be subject to very serious evaluation studies, almost in real time, if you like, perhaps by third parties, but certainly by the Federal Reserve, to show how and why and when they're working and when they're not, so that we can assess going forward whether this is a good set of measures to take. Thank you, Mr. Chairman.
Thank you very much for your testimony. Our next and final witness is Dr. James K. Galbraith, the Lloyd M. Benson Jr. Chair in Government and Business Relations at Lyndon B. Johnson School of Public Affairs at the University of Texas at Austin. And you are recognized for your testimony.
Thank you very much, Mr. Chairman, Ranking Member Backus, members of the committee. It is, again,
pull your speaker a little bit closer to you.
Right.
There.
It is, again, a very great privilege for me to appear today at these hearings, which, as a member of the staff of this committee, I worked on from their inception in 1975. I want today to make about 6 points that are really quite broad in their scope, but related to a central question or a central argument, which is that the crisis that we are passing through at the present time is qualitatively different from the economic downturns with which we have recent experience, and therefore requires us to adjust our thinking in certain important respects. The first one of these has to do with our treatment of the short-term outlook, that is to say, of the baseline forecast, which is very similar as between the Congressional Budget Office's baseline and that offered by the Federal Open Market Committee, both of which show a mild to severe downturn this year, followed by a turnaround and a period of growth beginning in 2010. I think this is substantially too optimistic. I think it's predicated on the mechanical inclusion in the model of the concept of a natural rate of unemployment toward which the economy will return by some unspecified process of labor market adjustment, and it's inconsistent with the likely path of liquidation of household debts, which is very much underway at the present time. And the result of this is that I'm very much in agreement with Alan Blinder that this year is likely to be substantially worse than the forecast. And even if there is a bottom at the end of this year and a slow rate of growth afterwards, that means that the ongoing rate of unemployment will be very high. And I think Chairman Bernanke was at least minimally realistic about this, that we're talking about 9% with no short-term or medium-term recovery of that rate toward high employment in prospect. The automatic stabilizers and the recovery plan just passed will help, but they will not rectify that basic situation for a long period into the future. Second point is that in this situation, with a very, very strong liquidity trap in place, well, monetary policy has been very helpful in preventing a collapse of activity, and I again share Alan Blinder's high regard for the actions of the Federal Reserve in the crisis, and in particular by its effective measures in the commercial paper market. The fact is that the ability of monetary policy to deal with the crisis going forward is relatively limited. We have had a policy of zero interest rates. We are going to have that policy for a period in the future. It has not succeeded in restarting borrowing because the risk premia on private borrowers are too high, the profit expectations are too low, and the collateral is too weak. And in addition to that, the policy of zero interest rates has an adverse effect on the fiscal side because it depletes the incomes of those who have cash reserves, and that affects their spending power, and that's particularly a problem for the elderly. Policy communication and selective supportive asset classes are not useless, but they are weak reeds in this situation. Third point relates to the plan with respect to the banks. I think it's plainly an effort to buy time in the hope that a financial market or broader economic recovery will refloat some of the biggest banks from the troubles in which they're presently in. And it's conceivable that it might do that, but it's also possible that the plans as presented might fail, which in that case would compound the taxpayer losses which are already in view as the guarantees that may be offered on the troubled assets are finally called. I'm pessimistic about this, mainly because I think that a proper due diligence on the underlying assets, particularly residential mortgage-backed securities, as I say, an inspection of the loan tapes, which by and large has not been done so far as I understand, would show them to be rather badly infested by misrepresentation and even outright fraud, and therefore unmarketable in the private marketplace at essentially any price. And if that's the case, the sooner we come to grips with it, the better, because it's only through coming to grips with it and writing off assets which cannot recover that we will put the banking system as a whole back on a footing where those banks which are in better shape will be able to lead the way toward a restoration of private credit markets. And here I do have a difference with Professor Blinder in that I think our experience with pass-through receiverships in the workout of the savings and loan crisis was very extensive in the early 1990s, and more recently with such institutions as NDMAC, which is in such a receivership now, is reasonably good and reasonably free of political interference, and this is indeed a job for the regulatory professionals, the only real question being whether they are sufficiently staffed up and prepared to handle that job with the scale of the institutions that we're just talking about at the present moment. In any event, the banking plan is unlikely to restart credit effectively because I believe it is based upon a misconception of what credit is, almost a rhetorical or metaphorical matter. We hear a lot about restarting credit flows, but credit is not a flow. It doesn't come from one place to another. The problem is not a blockage. Credit is a contract between two equal parties, the lender and the borrower. The borrowers have to have reasons to borrow, profits in prospect, and they need to be credit worthy, which is a problem of the underlying asset that they bring as collateral. The first condition requires strong growth of demand, and the second depends upon fixing the foreclosure crisis and the chronic oversupply of housing, at least so far as residential credit is concerned. Okay, the fourth point is that the problem of demand is that compound of debt deflation in the household sector, and also, I would argue, a terrific squeeze on the elderly, which is hitting them from all sides, affecting their home values, their equity holdings, and their interest income. The household income problem could be met by a substantially larger amount of tax relief working through the payroll tax, for example, a holiday on the payroll tax. The squeeze on the elderly could be met by raising Social Security benefits. And so from this point of view, I would suggest that as we go forward, we should stop thinking about the Social Security system as being a burden, but rather as potentially one of the more effective ways to restore effective demand in a crisis environment. Obviously, it's going to take time before we can decide for sure where we are, whether the optimistic forecasts that we are seeing are in fact accurate or in fact, as I believe, too optimistic. But in 6 months or 9 months, we would be able to make a judgment on these matters, and we should, I think, at that point be prepared to consider a substantially larger spectrum of aggressive interventions than we have seen so far. I want to say very briefly on the matter of housing. Like many members of this committee, it's important to stress the centrality of dealing with the foreclosure crisis to the ultimate resolution of these problems. In Texas in the 1980s, it took us 7 years to get through a housing crisis. This is one on a substantially larger scale. The problem has to do with the fact that homes don't disappear. They tend to stay as a drug on the market for quite a long period of time. Keeping people in their homes is about the only way one can effectively reduce the oversupply. That can be done either through resetting mortgages or by some mechanism that would convert to rentals and leave the former owners in a position to buy them back at an appropriate opportunity. But either way, that's a very big, arduous job requiring a lot of judgments about individual cases. The sooner it's started, the sooner it can get finished. If it isn't started, this problem is simply going to hang as, I think, the fundamental obstacle to a recovery of the credit mechanisms for quite a long time into the future. My broadest point is that we have been treating this crisis as something, again, as an artifact of our projections, as something that's likely to be over within a couple of years, returning us to a situation of normality in which we will be back dealing with more familiar problems. And I don't think that is an accurate perception. I think we will not return to normal. This is a historical event, like the Great Depression in that respect, which can only be dealt with by creating, in effect, a new world, a new economy, a future which will not resemble the 30 years of the recent past. So the future is something that we now have to build. It obviously is going to involve reconstructing our public infrastructure on a long-term basis. That's something that we should be planning to do now, and dealing with our energy and climate change problems, which are obviously essential to the sustainability of any economy that we may construct going forward. Thank you very much, Mr. Chairman.
Thank you, gentlemen. Let me actually turn to a couple of the points that Professor Galbraith made. I was particularly pleased to see you include the language about Social Security. The notion that our long-term budget approach should be to focus Social Security. It has two problems for me. One is not directly relevant here, but except in the broader sense, and that is it puts way too much attention on Social Security and way too little attention on the military budget. We are in the process now, I believe, of being asked to commit, at least this is a policy from the previous administration, several $1 billion in tax revenue to protect the Czech Republic from Iran. I am not a regular reader of all the fatwas, but I am not aware that the Iranians have threatened the Czech Republic to the point where we need to put billions of dollars in to defend them. I was pleased to see the President refer to the need to cut unneeded Cold War weapons there. On the other hand, though, on the Social Security issue, and you mentioned, Professor Galbraith, obviously, Medicare and Social Security. I do think, and I know you agree, there's a separation because it's not that Medicare does not deserve attention, but it deserves that attention in the framework of a broader health care policy.
Correct.
So let's start with that one. And there's a point I want to emphasize. You talk about, for example, the advantage of dropping the Medicare age. What would the impact be, for instance, on the automobile industry if we were to do that? We're going to be confronted with a need to provide some aid to keep the automobile industry, the American automobile companies, functional. What would the impact be of the drop in the Medicare age, for example, and other related health care issues?
Well, I think in a great many industries, including the auto industry that are in crisis, it would have two effects. It would relieve the industry of healthcare burdens for older workers, but it would also give a fair number of workers who have the resources to retire but are unwilling to do so because they don't want to lose healthcare coverage a chance to take that opportunity. And so it would relieve the industries, it would enable the industries to downsize and restructure in a much more orderly way.
Well, that's important. Actually, and I will confess, I have been thinking about the first of those, which was taking the burden off. It does seem if we could somehow get the burden of retiree and even current worker health care off the backs of GM, it would go a long way to solving it. But the incentive to retire or the removal, a disincentive against retirement is also very important. On Social Security, I would ask you, because I don't think this gets enough attention, to elaborate on the argument that this argument that Social Security is in a crisis, and if we do not do some drastic changes, including some reduction of benefits, that we will default on our promise to people who plan to retire in 30 years. What's your response?
Well, the U.S. government need not default on any of its obligations. The issue for us going forward is how do we provide an adequate retirement for an elderly population which is growing. And we have, of course, had a balanced approach to that with a certain element of private asset building. The real crisis is there. Social Security exists as a way of buffering the elderly against that problem and really should be seen as a tool toward that purpose. There is no reason, in other words, to treat Social Security as somehow kind of a financial albatross for the federal government. It is, after all, the one part of the federal government which has its own revenue stream that's assigned to it. It's not true of the Pentagon budget, not even true of net interest, yet nobody believes that the federal government is going to fail to provide for national security or fail to pay the interest bill.
Let me ask, or I'm going to start with Dr. Binder. The last point I would ask is, one of the things we are told we have to worry about is that U.S. Treasuries will lose their appeal as an investment vehicle and that we will be severely disadvantaged. I will say that I see no evidence of that happening now, and when I think about whether or not people can buy U.S. Treasuries in the future, I am reminded of a figure I often quote, the 20th century philosopher Henny Youngman, whose response to the question, how's your wife, was compared to what? And I think when we are told people are not going to invest in U.S. Treasuries, the question is compared to what? Are we in danger, if we don't make some drastic changes in public policy, let me start with you, Dr. Blinder, of seeing a drastic decrease in people's willingness to buy U.S. Treasury paper?
I think in the near term we're in no danger for exactly the Henny Youngman principle. I mean, look what's happened recently. As we all know, this mess, this worldwide mess, started here, right here in the good old U.S. of A., and the whole world is trying to buy U.S. Treasury bonds. So we are really the safe haven. That said, as you all know, we're now looking at budget deficits of 10, 12, 14% of GDP. I think that's the right thing to do in the current circumstances. We're in terrible need of stimulus, both from monetary and from the fiscal side, given the state of the economy. But there's a limit to how many years you can keep that up. And so I think it was really just the right thing to do, even though a lot of commentators were scratching their heads about the current contradiction, for the administration to talk about long-run budget control at the same time that it sounds contradictory, right? You're ballooning the budget deficit in the short term, and you're talking about long-run budget control over a period of a decade. But it's not a contradiction, and it's the right thing to do. I do have some fear. I wouldn't put a very high probability on it, but some fear that if the view became dominant in the marketplace that the U.S. government was going to run a 10% of GDP deficit more or less indefinitely, then I think we have to worry about the interest rates and the financial markets' attitudes towards Treasury debt.
Well, I'm certainly concerned about making U.S. Treasuries attractive for the long term. I think that's we have to be vigilant about it, quite frankly, Mr. Chairman. And to the extent that we are going to run deficits like we are this year, as far as the eye can see, and some people worry about that, it's going to be hard, quite frankly, to get people to buy these treasuries for the long term. I think it should be a direct concern. And by the way, I think there is an inconsistency about currently increasing the deficit by a large amount and simultaneously saying it's not going to be for long. I think it's one case, here's what I'm doing, and the other case is here's what I'm saying I'm going to do. And it raises questions about consistency, which would be concerned about. On Social Security, I'd say just seems to me this is something that could be addressed. You know, it's more of a political than an economic issue. I think we would show a great deal of leadership and confidence in government if we could come to grips with that sooner than later. And there's more difficult problems, the ones you're asking about. But why not take that on at this point? It is a long-term issue, but it's a very important one to show that government can address it.
I would just add, and I understand the potential inconsistency. I very much agree with Dr. Binder. I think we often do things to respond to an emergency that we don't necessarily want to do in the future. But it does seem to me that was one argument for, as we did the economic recovery, or we do similar things, if we have to do more, I would have done more, to try and do one-shot things that contrary to some arguments, to the extent that you're doing things that have an immediate impact but don't build in a repetitive pattern, that you alleviate some of that inconsistency. Professor Galbraith.
Just on the question of sustainability, I don't think there could, in principle, come a time when people would not buy Treasury securities. The issue is at what price, and specifically whether we're looking at an inflation problem down the road, which again is what Professor Taylor mentioned as a concern. And I think that is a concern, an appropriate concern for another day. I don't think it's likely in the present environment or for the foreseeable future, simply because there's so much excess capacity, debt deflation at home, and because of the rush into the dollar is actually driving down our costs. Well, I think enough on that. Thank you.
The gentleman from Alabama.
Thank you, Mr. Chairman. I want to say for the record that my wife is wonderful. So that's how I'd answer the question as a married man. But
well, I'll listen carefully. You never know someday for me, so I'll store that up. In
yeah,
case
I
of a
could never
future
get away with that answer. Thank you, Mr. Chairman. I spoke to the Women in Housing and Finance group here in Washington about 6 weeks ago, and this is something I said, and I may want your comment on this. I said the critical failure in the government's response to the financial crisis is that we are waiting for events to overtake us and then reacting in an environment of crisis. The essence of the problem, the core breakdown in decision making, is that we postpone decisions until we're overwhelmed by the problems of the day. And I describe this as kind of a reactionary fire brigade mentality. And Dr. Blander, you I think called it an ad hoc piecemeal approach. You know, and some of the problems I see with that is sometimes we cross like the proverbial Rubicon. I mean, we're rushing to fix a problem, and we go beyond points where normally we'd sit back and say, you know, what are the long-term consequences of this? And just like your comments.
I think there's some truth to that, both to the worry and to the criticism. That said, as these really stunning, and I would say it's not too strong a word to say unbelievable events have unfolded since the pot blew in August 2007, it would have required superhuman foresight to see what was coming. I mean, even if it's just to take something concrete, I think even in early September, to foresee what was going to happen with AIG on around September 16th or 17th or whenever it happened.
And that's 2008.
2008, yes, would have been next to impossible. It took my breath away what happened on those days. Now, if you raise the point, well, was that very ad hoc? Yes, it was. Mightn't it have been done better? Probably.
No, and let me say this. I agree with you. In August, September, no one, I don't think anyone had any idea the magnitude of this. I think by October, November, we did, but you know, there's still not a comprehensive.
Right.
Although the term auction facility of $1 trillion may actually be, you know, an example of something that is. Now, let me say this. You asked about it. They're still going through the regs and rules, and it's not out there yet. So, but I'm sorry.
So yeah, I know. I agree with what I think you just implicitly said. I think the TALF is a rules-based, transparent, systemic, and systematic approach to restoring the viability of some of these credit markets, and that's what's wanted. I mean, I think that if I look at the pantheon of things that have been done, my favorite things are starting with the commercial paper facility and then leading into the TALF. I think those are real steps towards a cure. I think I said in the testimony that, yeah, I did, that I was praising the Fed since October. You could look back to that September, October, and even before period, and I think find things to criticize. I see a turning point, although Chairman Bernanke didn't make a big deal of it at the time, as coming when they did the commercial paper facility. That was sort of the first step, and now it continues, and there's no guarantee that it's going to work, but the early returns, I'd say, were good. The commercial paper market now is very much back on its feet. When they started, there was one buyer, the Federal Reserve. That's not true anymore. The high-quality MBS, the Fannie and Freddie MBS market, because of the Fed's purchases, are looking much, much better than it did before, and that's had spillover to mortgage rates and so on.
And let me ask Dr. Taylor and Dr. Galbraith, too.
Yeah, let me comment on this, because I think what you say has a great deal of truth, Mr. Bacchus. In fact, I've been studying this crisis for a while and decided just about the time that Ellen Blinder said things turned to just write up, if you like, my assessment of, first, what caused it, second, what caused it to last so long, because it did flare up in August of '07, and third, why did it worsen so much last fall, in the panic of last fall. And in each case, I look at the kind of things you're saying, that government basically didn't get it right. They got off track from some policies that were working really well in much of the 80s and 90s. First, some monetary excesses, which led to this boom and bust in housing. In terms of lengthening or prolonging it, if you like, misdiagnosing and then reacting in ways which didn't do any good. And by the way, I would include the stimulus package of last year, the stimulus of 2008, which sent checks to people and didn't do much good, or I'd include the term auction facility in that. And then finally, last fall, the very ad hoc reaction, which confused people, and the testimonies were taken very negatively and caused a lot of fear. And so in all those cases, it seems to me you're right, that sort of the government actions and interventions led to where we are, and I hope things are getting better. I don't think I think there could be more rules, if you like, with respect to how the Fed's operating. I don't like very vague statements about the total amount of reserves they're creating. I think that is going to lead to even more concerns, and it's good if they're being more specific about their initiatives. I worry about the Treasury's request for a whole new initiative for consumer and business lending. I don't know where that came from. I'm sure that I know the board has agreed to it, but still, that raises questions about the nature of responses and same kind of things you raise in your point.
Ms. Galbraith.
A modest difference with my colleagues. I think it was possible, and that there were people who had a reasonable understanding of how dangerous the situation was becoming as the subprime lending expanded, as the housing bubble expanded. And there were people in the spring of 2008 who had a pretty good sense, who were close enough to the markets and had the right sort of models, who had a pretty good sense of how bad the crisis could get. And I could submit for the record a memorandum that was based upon a seminar in June, which I think got the scale and character of the subsequent events approximately right. The problem here is that when you have a small group of people who do appreciate it, they are generally unable to project that to the larger policymaking community. And that's not by accident. It's simply that people who are very specialized and who see these things generally don't have the same reach and influence that people who are less close to the events may have. And Cassandra was always right, but no one believed her. There were reasons for that. And so in this situation, we are still, I think, underestimating the gravity of the crisis and still in a situation where time will have to pass before the policymaking community is willing to move at the scale that's going to be required actually to deal with events.
I fear that the number of people on the committee who've shown up will continue to grow, and while we gave pretty much latitude for the opening statements, that we probably ought to return to an element of discipline in the marketplace here. So if you all don't mind, we'll try to return to the 5-minute parameters, and it may be necessary under those circumstances for you all to submit responses in writing to some of the questions that get asked, because otherwise we're not going to be able to get to everybody. So, and I'll try to apply that discipline. Are you ready? To myself, since I'm the next person to be recognized. Dr. Taylor, let me clarify the reserve chart that you have given us to this extent. The Fed, is this the same thing that yesterday Chairman Bernanke was describing as assets, or does the Fed itself have some kind of reserve? Is this a dollar for dollar assessment, or is this something, a reserve similar to what we would think of as reserves in a bank, for example?
These are the liabilities that correspond to the assets. He was talking about the assets, the commercial paper or the mortgage-backed securities that they were purchasing.
But it's a dollar for dollar. If he's valued the liabilities and he's valued the assets correctly, it's a dollar for dollar.
As they're created.
So in that sense, it's not 10% of the liabilities. It's an actual offset figure. Is that right?
Yeah, it's really as they're created. In other words, if you were to go out and buy a mortgage-backed security, you'd have to pay for it with something. Well, so does the Fed. The Fed has to pay for it. What they can do is pay for it either by actually printing the money, or in this electronic age, crediting their accounts to a commercial bank. So their bank has a deposit. So that's how they pay for it. They got to pay for it. You know, it's not just doesn't.
So in that sense, it is a dollar for dollar.
As it's created, yes.
Okay, all right. I just wanted to be clear on that. Dr. Galbraith, your merger of this question of Social Security with the situation that we're in actually raises something that another academic that I was having a conversation with last weekend suggested, and I'll put it out here, although he's promised to send me something in writing that kind of fleshes it out. I may be misstating it. But his idea was that since we've now nationalized, federalized, taken over Fannie and Freddie, at some point their assets will be fairly substantial, we hope. And that short term, longer term, I'll deal with longer term, when those assets become more and more valuable over time, it would be a wonderful source of revenue for Social Security. And I guess the corollary of that is shorter term, we ought to be thinking about merging these entities to use some of the Social Security surplus to get us through this transition until housing stabilizes and those assets come back. Is that even remotely akin to what you're suggesting here, or can you give me your reaction to that notion?
I think there are many ways to mobilize resources and put them to work. And you mentioned the Social Security surplus at present, which is to say payroll tax revenues greatly in excess of benefits currently being paid. There's really no reason for that. I think that's a target of opportunity. If you wanted to provide tax relief to working families, you can cut the payroll tax. You will not harm the finances of the United States government by doing so, but you have very effectively put cash in the pocket of working families who can use it to pay their mortgages and their car debt, and that's the useful way to think about this. On the other side, Social Security benefits are a great engine, very widely received in the elderly population, and putting more resources, putting more money into those accounts is a very effective way to hold that population a little bit harmless from all of the other losses that they're presently suffering.
Either of the other witnesses have a quick response
Yeah,
to
if I could just
that
very
notion,
briefly.
Dr. Binder?
We are doing that in a sense. It's that when you look at the unified budget, which is what you generally focus on in terms of measuring the deficit, the Social Security surplus part is in there, and the non-Social Security part would have an even larger deficit. So it's all put into one pot, and you could say that we're now using it for something because we're in a big deficit position. On the asset sales that you mentioned, and we all have our fingers crossed, we can sell some of these things at a profit some years down the road, that will again go into the kitty, into the federal kitty, just as it's going out of the federal kitty now. But importantly, that's a one-shot event. If you think about closing a long-run actuarial gap in Social Security, that's just a one-shot event and not a permanent flow.
Okay, I'm going to impose the discipline on myself first so nobody else thinks I'm being unfair to them. Mr. Castle is recognized for 5 minutes.
Thank you, Mr. Chairman. Dr. Taylor, you had 3 recommendations, and I took brief notes. I may not have gotten this quite right, but the last one was something the effect of serious evaluation studies by the Federal Reserve, that is. Is that an evaluation studies of how their programs are actually working in terms of the advances they have made to the various institutions on the outside? Is that what that means, basically?
Yeah, that's exactly what I have in mind, and it's very important in public policy always to evaluate the effectiveness. I think in this case it's particularly important because, actually, as Mr. Bacchus was saying, there's a tendency to keep reacting and proposing new things. So my observation early on, for example, was that the term auction facility the Fed created, at least with the express purpose of reducing the spreads in the money markets and bringing LIBOR down, didn't really do that. And there's now multiple, 10 or 15 more programs that need to be evaluated in the same way. And it's important, too, because if these reserves, money is going to be brought down from my chart, it could be that some of these things can be ended if they're not being effective. So the TAF is still very large. Yep. There's still large loans to foreign central banks. So those might be the ways that some of this money can be brought in. But in order to know that, you have to see which are effective. Exactly. Basically just make some cost-benefit analysis. I think is very important.
I tend to agree with you on that. And Dr. Blinder, you indicated you think the Federal Reserve has done a good job, maybe since October, but it's done a good job on all this. Dr. Taylor had those 3 recommendations. One is, I think we probably would all agree on, but more transparency, and the website is a good start, he said, in that area. And then setting the ranges for reserves, and then the serious evaluation studies. Do you consider those, even if the Fed's doing a good job, do you consider those to be good improvements, or would you critique any of them or not recommend any of them?
I would be I'd be 100% behind 2 of them. The transparency and the evaluation. We should always be evaluating what we do, especially when we're stepping into uncharted waters. I might add, when you step into uncharted waters, the evaluation is not a trivial task because you're not modeling it on. I've done this 6 times before. The one that I would not endorse by any means is trying to establish some sort of target for the Fed's balance sheet. I think the conceptualization of the target that Chairman Bernanke has now, it's not at all numerical, is exactly the right one, which is that in this crisis, whatever it takes. If it's another 500 billion, it's another 500 billion. If it's not, it's not. We will get market signals as the markets return to normalcy and we learn that banks don't any longer want to hold these enormous amount of excess reserves. That's what they are. That whole gap that you see in Dr. Taylor's charts are excess reserves. Deposits haven't skyrocketed like that. These are mostly excess reserves. That's the symptom of a banking system cowering in catatonic fear. The one thing you're safe with is holding reserves at the Fed. They want those reserves now. As Dr. Taylor says, when the system normalizes, they will not want reserves like that. And if you leave them out there, you're going to have a lot of inflation. But the Fed will see that happening right now. So I just don't see that it makes any sense, nor do I see how the Fed could actually execute it if somebody was to suggest, if the Fed was to follow a suggestion to post a target for its balance sheet.
Okay, thank you. Dr. Galbraith, the mortgage bailout program, bank bailout program, to some degree was sold to us as troubled asset relief purchases, and of course it didn't unfold that way as it turned out. Do you believe that we need to have some program that's going to go after those toxic assets and relieve the banks of that responsibility? I continue to read that banks just can't return to normalcy without that somehow being undertaken. Where should we be going with that issue?
Well, this is an area where I think evaluation would also be very useful, because we are, I think, working with perhaps a mental model of these assets as marketable assets which are being priced at below something that may be their long-term reasonable value. And I'm not at all sure that that's correct. I suspect that a private investor who was charged with doing a real due diligence on these assets, who looked at the underlying loan tapes, would find that there was just not, in the nature of a subprime security, not any way that you could, in good faith, tell your client that you had information on the basis of which to value them. And if that problem is really pervasive, as some indications, a sampling of the files suggests it may be, then the sooner these assets are fully assessed and dealt with, written down, and then the institutions who held them evaluated on that basis, the more quickly we will get through the crisis, however big it is. If we make the other bet and that these assets will recover or can recover and are proven wrong, then we're going basically the Japanese route of forbearance and holding the institutions afloat without any real prospect that they will return to a normal behavior, and as you've just heard the other witnesses describe.
Thank you. Thank you, Mr. Chairman.
The gentlelady from California.
Thank you very much, Mr. Chairman. I think that the hearings that we've been holding, the bank CEOs that we've been bringing in and others, and of course Mr. Bernanke's testimony here yesterday, is helping us to get a better handle on what we can do public policy-wise to help during this crisis. I have a question that I would like to ask of any of our witnesses here today, because some of the actions that we have taken are not quite understandable. We have a number of small and community and regional banks that were invested in Fannie and Freddie. They bought their preferred stock because it was so safe. And when we took over, those small regional minority banks lost all of their preferred stock investment. Now, some of them, I suppose, will stand in line and beg for some TARP money. But it seems to me that somehow that preferred stock that they had in our government enterprise should have been protected and not taken from them. Are you aware of this, and you have any thoughts on that? I can start with Mr. Blinder.
Yeah, I am aware of it, though. I hope you won't quiz me on the exact details for any bank. I think it would be appropriate for the bank regulatory agencies, and I think they are, to make special allowances. Because it's a version of regulatory forbearance. Because after all, as you said, Congresswoman, the federal government did this to them. They were holding this stuff, this preferred. It was thought to be a safe asset. It was treated as a safe asset by the regulatory authorities. They liked banks having this on their balance sheets. And then there was a federal intervention that devalued the asset. I think it's appropriate bank regulatory policy, and I think I'm pretty sure the regulatory agencies agree with this, that you treat that differently than when poor banking decisions lead you to balance sheet troubles. So I would treat it mostly not so much in the way you suggested, but it's not so very different with regulatory forbearance. That is, this is a piece of your capital structure that we, the national government, impaired. You didn't do anything, and so we're going to give you a lot of time to get back to your capital position.
To Taylor.
Yeah, I basically just say I agree and just add that I think it's an example of what we were talking earlier about how so often what's happened here is there's been some government interventions that have had these unintended consequences. And of course, it's not just these banks that have held that. A lot of other private citizens and people have as well. So it's an example of to be so careful before you do these kinds of things. But otherwise, I agree.
Well, this was brought to our attention, and I think our chairman, Mr. Frank, dealt with it, but we did not deal with it in terms of getting our regulators to take a look at this. Chairman Frank, I just brought up the fact that for all of those regional banks, small banks, minority banks, that had preferred stock in Fannie, and when our government-sponsored enterprises were taken over, we allowed that preferred stock to be taken over from those banks. And now those banks, I suppose, have to get in line behind the big banks and try to beg for some TARP money. And it just seems to me there ought to be some kind of policy that would at least give some thought to how you give some protection to those regional banks, rather than have them come back in line over in the TARP line and say, lend me some money or give me some money so that I can stay in business. Dr. Galbraith, what do you think about that? And do you think, well, let me just say this. I had a private citizen come yesterday, and the private citizen said his whole family, his mother, all, they had preferred stock also in Fannie, and that just a few days before the government took over the stock, Paulson and others were saying that it was not in trouble. I don't know where these statements were made. I'm going to look for them. That there was no contact with them. There was no indication that these government-sponsored enterprises were in trouble, that they were going to be taken over. And they still, to this day, have not been contacted, even though they've lost everything. Dr. Galbraith, what do you think about the regional banks that lost all of their money, which put them in danger, and also private citizens who were not warned, have not been contacted, had no idea this was a government, as you say, intervention?
Well, I'm inclined to rely on Alan Blinder's authority on this matter as well, and to say that I think the position that he articulated is a very reasonable one. There are probably precedents from the era of the savings and loan crisis which are worth looking into for dealing with problems of this type, but I would have to look at the record to give you a better, more complete answer than that.
Thank you.
Who's next on the side now? Mr. Posey, gentleman from Florida.
Thank you very much, Mr. Chairman. Question for Mr. Blinder. You talked about the nationalization of banks in Sweden. What year was that? Did they formally nationalize them or just control them like we are?
My understanding is they formally nationalized some banks, and then to get around the problem that I was mentioning about Bank A, Bank B, they then subsidized the other banks so that they wouldn't be forced into it to fail.
Did it seem to solve their problems?
Yes, it did. I think they came out of that banking crisis, which was extremely deep and severe, quite quickly, and reprivatized the banks that they had nationalized. That's why Sweden is held up as sort of the poster child for successful nationalization and then denationalization.
Yeah, some of us think that's just a buzzword. Do you know what their corporate income tax rate was when they nationalized?
I'm sorry, I do not.
I think it was about 45%. You know what it is now?
I do not.
The nationalization didn't improve GDP. It didn't solve any problems. You know, it created an illusion, kind of like we are. I think their corporate income tax rate is probably 10 or 12 points lower than ours now. I'm not sure, but I think it was the focus on increasing their GDP, on creating jobs, real jobs, that solved their problem, and nationalization got credit for it, nationalization of the banks. Dr. Taylor, what happens if the foreign investors who are absorbed in their own domestic economic challenges decide it's not in their best interest to purchase our Treasury notes?
Sorry, they're not in their best interest to what?
Purchase our Treasury notes.
Well, that's the kind of thing you should worry about, if not today, in the future. And that's why I say it's so important to think about the things like Social Security, things about the fact that we've got a large deficit coming in now, and we should try to get that down. We probably shouldn't have had such a big one this year, in my view. So those are exactly the reasons I would be concerned. And you have a lot of people who've been buying our debt for a long time. Some people have been worrying about it for a long time. And I think we should worry about it, actually. We think it's important to do everything we can to make sure that people have confidence in the United States and in our fiscal responsibilities and our intention to support our debt no matter what.
Same thing with our secondary market securities.
Which securities?
Mortgage notes, our other
well, that's
paper.
anything that we're, of course, involved in now, absolutely. But from the point of view of individuals, yes. I mean, the idea is to do everything you can to be creditworthy, to maintain your creditworthiness, and to get back to, if you say, get back to basic principles.
Do you see any way a cram down would do anything but devastate that secondary market?
No, I think anything, and these cram downs or any of these special interventions, to the extent that you always have to think about what that's going to do to future borrowing, and to get out of this, you have to make lenders want to borrow if they're worried about cram downs or they're worried about interventions by judges that are ad hoc. It's going to make them less willing to lend and not more willing to lend.
Yeah, I wouldn't think anybody would buy anything that the government could simply just devalue tomorrow at an arbitrary, capricious rate. Dr. Galbraith, in your written testimony, you indicated that the arguments that Social Security and Medicare are a problem are mistaken and dangerous. Did I read that correct?
That's right, yes.
All right. I just want to make sure. I thought they gave me a paper that had some errors in it, possibly. You said the programs could not go bankrupt any more than the government of the United States could go bankrupt, which it cannot.
Correct.
Would you describe bankruptcy for me?
Bankruptcy is a term that applies to a private corporation which comes to the protection of a court when it's unable to pay its debts. And since the United States government cannot get into that position, essentially, it cannot go bankrupt in that sense.
So you believe the United States government can have no limit whatsoever on its liabilities and minimal assets, and that wouldn't be a problem?
Well, there are two senses in which one can talk about the word limit. Operational limit.
Let's talk about infinite debt.
Well, no, the question is whether there's
no assets.
Right. The question is whether there is an operational limit. The answer to that is no. Whether there are limits of prudence, the answer to that is yes. there. Obviously, the government can spend too much or tax too little and can conduct its affairs in ways that are economically unwise. The consequence for that, and this gets back again to the colloquy you were having with Professor Taylor, is not that people would refuse to buy our...
in time. Could you give us a written answer to that?
Sure.
I mean, I realize, Mr. Chairman, that
But in one word, the problem is inflation. Depreciation.
The gentleman will get a written answer. The gentleman from Kansas. I agree with what my colleague from North Carolina said, that we don't have the luxury of time. We've got more interest. So, gentleman from Kansas.
Thank you, Mr. Chairman. Dr. Blender, in these difficult times when our constituents are anxious and frustrated with the state of our economy, I believe transparency is very, very important to communicate what actions we're taking to protect U.S. taxpayers. An issue that came up at our Oversight and Investigations hearing on Tuesday of this week was a potential oversight blind spot that may exist at the Fed. In particular, I have a concern that there may be a lack of sufficient oversight of TARP funds that pass through the Fed. I understand the Fed's TALF program will use TARP funds to lend up to $1 trillion to thaw the consumer lending markets. The acting Comptroller General, who testified as a witness before our hearing on Tuesday, expressed concern about GAO's ability to oversee TARP funds passing through the Fed. I believe independence for the Federal Reserve is very important, but when the Fed invokes emergency powers through Section 13.3 of the Federal Reserve Act and greatly expands its balance sheet, should Congress consider adding emergency oversight authorities to better track the use of funds? And before you respond, let me give you one example. The Congressional Oversight Panel at this hearing, led by one of the witnesses, Professor Elizabeth Warren, testified at our hearing Tuesday that the Treasury Department overpaid an estimated $78 billion in its first round of investments into troubled banks. Warren testified, quote, there may be good policy reasons for overpaying, but without clearly delineated reasons, we can't know that. Without strong oversight protections of the Treasury's use of TARP funds, we would not have learned that. So my question is, does this argue for having emergency oversight authorities at the Fed when they use emergency powers and taxpayers' money?
It's a hard question. There is, let me say a couple of things that I know and then speculate.
Yes,
the TARP legislation that was passed by the Congress has multiple layers of oversight. The original infamous 2.5-pager, which you'll remember, didn't.
Yes, sir.
But what was eventually passed had tremendous amounts of oversight, some of which you just cited. There's the GAO. It has many, many levels of oversight. So to the answer, should it have heavy, heavy oversight, my answer is yes, and I think it has that. The problem that you were alluding to, Congressman, is that the early expenditures of the TARP, I don't want to say all of the first $350 billion, but a lot of it seems to have been poorly documented, poorly designed, by the way, poorly documented, poorly accounted for, et cetera. Some of this I think you can forgive that they were in a hurry, but I think a lot of it you can't forgive, that it just wasn't done the way it should be. On the Federal Reserve, this committee and the corresponding committee in the Senate have oversight over the Federal Reserve. Chairman Bernanke and others come down to testify frequently. It's not obvious to me you need any further authority. You do have oversight authority of the Fed. It is reporting to you now, I think, you'll correct me if I'm wrong, bi-monthly on the Section 13.3 actions, the extraordinary actions. And of course, should the Congress reach the judgment that that's not frequently enough, it can request that that the Fed report more frequently than that. It's not obvious to me that any further powers are necessary to get done what you quite correctly want to get done.
Thank you, and I would ask the same question if any of the other witnesses have additional comments.
I think that the mere fact that you're asking this question about whether you need more powers over the Feds is an example of my concerns that the Fed moving in this direction raises tensions about their independence. I really think the independence of the Federal Reserve has been very important and why we've basically had good policy for 20 years. And there's a concern about these actions losing some of that. And so I would say whatever you do, exercise the longer term and the shorter term, maybe find other ways to consider accountability, if you like.
Well, as I said, I agree with that, but I'm concerned if in fact the Treasury Department overpaid an estimated $78 billion in its first round of investments in troubled banks, we need to address that situation to make sure that doesn't happen. Dr. Galbraith?
I spent many years, Congressman, sitting behind where you're sitting now, and so I very much take the view that while the Federal Reserve is properly independent of the President and the executive branch, it is in no sense independent of the Congress. It is a creature of the Congress, an artifact of the Federal Reserve Act, and you do have the authority and the responsibility to exercise appropriate oversight over the central bank.
Thank you to our witnesses, and thank you, Mr. Chairman.
The gentleman from Minnesota is next, I believe. Yes, gentleman from Minnesota.
Thank you, Mr. Chair. You know, given that our economic system is generally designed to be self-correcting, you know, what recommendations do you have to minimize the other sectors right now that are being protected somewhat? The financial sector, the auto sector, where we've had some discussion, these organizations that are essentially too big to fail. Do not some of these sectors need to have some correction applied to them and through normal market forces? And are the interventionist policies of the government really that are being discussed now, are they the answer to sorting out or downsizing or right-sizing these sectors? Can you provide some perspective on that?
I don't think they are the answer, Congressman, but I think I would appeal to analogies been made by Chairman Bernanke and others that there's when the house is burning, you put out the fire and you don't worry about the fire code, but you do worry about the fire code later. So, and I take your point about the fire code. I think we need very large changes and multiple changes in the regulatory system. I think, among others, to take one of the points specific. So that's a very long list of things, which I won't try to do now, but just to take one point that you raised about too big to fail, I think one of the things, once we've got this, our arms wrapped, once we've got this problem, quote, solved, it'll never be literally solved, but once we're back to something like normalcy, we're going to be facing a financial system that has some giants in it that we never contemplated, results of these forced shotgun marriages. And that really raises the too big to fail doctrine to an entirely different level. I think we're going to have to think about whether later, not now, we're going to have to think about whether one approach to too big to fail is to make it very difficult for organizations to actually get that big. That's a very large departure from what we've done in the past, but I think it should be on the congressional agenda. But again, for the future, not for today.
Well, I'd be happy to hear some of the other comments you might have, but in that sense, are we better off not to have 100 insurance companies or 100 different, you know, spread out the risk so that we don't have as quite the too big to fail concept? You know, one AIG, for instance, which we could effectively nationalize some of these institutions.
I mean, that's a good example. I think it was a tremendous mistake made largely by the private sector and really not by the state to have so much of the CDS risk, an enormous amount, concentrated in one company. I mean, we should never have gotten to a position like that.
Mr. Taylor?
So with respect to the self-correcting mechanisms, I sometimes think that government should have more faith in these self-correcting mechanisms and in some sense screws them up, if you like, by intervening too much and too often. Quite frankly, one way to deal with the too big to fail problem is to establish a credibility about sometimes saying no. It seems to me more often it's going to help if you can establish the credibility of an institution that, well, this may not be too big to fail, and we'll have other ways to deal with the impacts if your institution fails, and therefore not just create the expectation that government will always be there. As I mentioned before, and I study this crisis, it seems to me so often it's the government actions that have prolonged and worsened things, not the market. And the presumption, of course, these days is that government will be able to fix it. But I think dealing with the too big to fail through better market mechanisms, better resolution mechanisms is important. But ultimately, it's got to come down to credibility of the policymakers, occasionally, in the right circumstances, with a lot of notice saying no.
I would say most living systems are self-adjusting. Animals get sick, they normally recover, and sometimes medicine helps them recover a little more quickly. But there are circumstances when they won't, or when it will require really exceptional interventions to prevent the animal from perishing. to make recovery possible. And even then, you're never entirely sure. That's when you need the intervention to be conducted with the greatest skill, and you're never entirely sure that it's going to succeed. And the trick is distinguishing between this normal condition when recovery is to be expected at some point and the exceptional condition when you're at risk that recovery may not happen. And that's the problem that I see facing the system at the moment, is that we are subjecting it, it's being subjected to such severe stress, both failure of vital internal institutions, the banks, and external shocks, that we have to think really quite freshly about what the appropriate degree of policy intervention is.
You go back.
Thank you. We have been called for a series of 2 votes, but we want to get one additional questioner in first. Ms. McCarthy is recognized.
Thank you. Thank you for the hearing. Dr. Gilbreth, I was going through your testimony, and one of the sections was keeping people in their homes. That's the area that I'm really concerned about. This morning's unemployment numbers came out. They were not good. So we have another 500,000 people without a job. And you came up with 2 ideas, and you also were looking at a Warren Mosler, who I don't know, coming up with an idea. Could you go over some of the ideas that you had, and certainly Dr. Bender and Dr. Taylor, you know, if you have ideas too?
My thinking on this is informed to a large extent by what was done by the Homeowners Loan Corporation in the 1930s. And what the government did at that time was to basically take over at some discount the troubled mortgages, renegotiate them, and manage the housing so that people could stay in their homes. And they basically managed that for about 1 million homeowners during a 15 or 20-year period. Mr. Mosler's idea, which I think is an interesting one because it would minimize the amount of institutional disruption. In other words, resetting mortgages requires that you intervene with the servicer. And Warren Mosler's idea is that you allow people to go through the foreclosure process, but then have the government pick up at the house at the lowest, an agency at the lowest of the appraisal price or the mortgage balance, and allow the previous owner, if they want to live in the house on a fair market rental basis with an option to repurchase when conditions improve. So at that point, you're resetting essentially rebooting the market mechanism for housing, but also trying to the maximum extent to keep homes occupied so that you stop the cycle of blight, which is going to keep driving down home values and also damaging the quality of life in neighborhoods for an indefinite period into the future otherwise.
Do either of you have a...
Just very briefly, I think one of the problems here is the disconnect between the servicers and the investors. And in a normal circumstance, a bank would be able to work it out with the customers. They know them in the neighborhood or know the nature of the loan. So dealing with that is an issue. And one suggestion is to give some incentive to the servicers, and I think that's actually being considered now by the administration. But I think another thing would be to work on, again, transparency. A lot of the original loan documents, loan documentation, are not made available to the investors. And it's complicated because of the securities being packaged. But if the servicers would provide more information about that original loan documentation, then you'd be able to distinguish between, if you like, the creditworthy borrowers originally and the ones that, you know, it was a no-doc loan, if you like. And I think more, maybe even require transparency, but certainly more transparency is needed there.
Very briefly, Congressman, first of all, the administration's program has a number of things in it that would go to exactly what you're talking about, keeping people out of foreclosures, including this approach to the servicers, so to free them of the legal liability, or at least to minimize it, that they now have. Secondly, this committee originated the Hope for Home, well, this and the corresponding committee in the Senate, the Hope for Homeowners program. As you'll remember, to get that passed, the parameters were set so that the budget cost was practically nothing. That program could be liberalized and made to work. The problem basically was it was put in a budgetary straitjacket that it would cost nothing. You don't get too much when it costs nothing. But the parameters can easily be changed. I'm talking about what it costs for the FHA guarantee, the eligibility requirement, and so on, by an amendment to that act. Thirdly, finally to the specific point you made, this foreclosure mitigation won't be the whole thing, because the sad truth is some people got into ownership that never should have. They always should have been rentals, and some of these are just not salvageable. And so some ideas about converting owned homes to rental units, I think, are going to be a logical part of the ultimate solution.
Well, my concern is, especially at the fair market price. I come from New York. Fair market price for to rent an apartment is almost a mortgage payment. Where you go south or you go in the Midwest, apartments are much certainly you get a lot more for your money, to put it that way. That's my concern, because with all these people that are going to be going out on unemployment, they've been paying their mortgage. Most of them probably have a 30-year mortgage, and yet they're going to probably find themselves in several months down the road that they don't have the money to pay for the mortgage, and that's what I'm concerned about. These are good people, good risks, hardworking people. Hopefully we can work something out to protect those people. What are we going to have? Several 100,000 people homeless? I mean, one way or the other, we're going to have to pay for them. Thank you. I yield back.
Gentlelady's time has expired. We're in the process of having 2 votes, so the committee will stand in recess until immediately after the votes. Anybody who wants to ask questions, please come back immediately, and we'll try to get back.
Yeah, gentlemen, these may be the only votes today, I think, because they pulled the vote. So people will be able to come back undisturbed if the members of the panel can stay. Thank you.
Excuse me?